they've done that. It's a reset in our brain. They're still fine, folks. They're 5 and 6% on used homes with constricted inventory, and on new homes. You can afford it. We're back to normalization. The rates are not high like you think they are. You're just used to free money.
You're listening to Ice Cream with Investors, a podcast that is dedicated to teaching you how to better invest your money so that you can live a more intentional life. I'm your host, Matt Four, and it is my goal to teach and empower you to remove the roadblocks to your financial success.
All right, Todd, welcome to the show.
Hey, Matt, thank you for having me today. It is absolutely a joy to be here, and just really excited to be a part of your day-to-day, your vision, and hopefully I can provide some value to your listeners out there on what I do in the space that I operate.
Absolutely. Well, we like to start with the difficult questions here. What's your favorite ice cream?
Vanilla bean.
Vanilla.
Not vanilla, vanilla bean. Vanilla bean is my absolute favorite. It's got to have the beans in it.
I am glad you made the distinct clarification there, because vanilla and vanilla bean are definitely two different flavors.
They really are. And vanilla bean is a very, very good flavor. It's actually, I think, one of the most popular flavors out there. I understand that it's like 40% of the nation prefers vanilla. I don't know that to be true, but You must know the answer to that. But I understand vanilla is the all-time favorite.
Yeah. Well, tell our listeners, what's the scoop? What do you do today?
So I started off in fixing and flipping properties back in the 90s. I've been in this business for quite some time. I fixed and flipped about $100 million in properties, done some multifamily, most in the SFR space. And then in 2006, well, I had a previous company that I owned and operated in facilities maintenance. I had about 500 employees, and I sold that company in 06 and decided to do my passion, which is fixing and flipping, which eventually rolled into lending. So ZINC was born in 2006. As a licensed lender, we operate in about 40 states, and we specialize in fix and flip properties for investors that buy properties at a disposition value, some element of distressed. They don't have conventional financing ability. So these are, REOs, fire damage, water damage, rental properties that have gone astray. It's that ugly duckling house on every street that we all are so familiar with. The Christmas lights hanging out there in June, the engine in the front driveway, the car parked up on the grass, and weeds overtaking the front of the house. So, so we loan money to those investors that buy those properties, rehabilitate them up to conventional standards, and eventually sell them to what is typically a first-time home buyer. I call this my win-win-win strategy, and I mean that. My investor wins, my borrower. They make 35 to 75 grand. They bought a distressed piece of junk. They turned around and fixed it, flipped it, added value to the neighborhood. They made some money. The buyer, the ultimate end experience wins. They got a first-time home at a rehabbed price, and they're excited and they're in tears. The neighborhood wins because they took that dumpy house, worst on the block, lots of noise at 3 a.m., and we've turned it into the best house on that block. And finally, my investors win in our debt fund because they get a great yield with excellent protection of principal, excellent security, and passively investing in real estate, one of the best products in our country. So it's kind of my win-win strategy, and it's worked very well for me. So I've been in the business about 20 years, 100 million in fix and flip myself, and about $1 billion in lending across the 40 states for which we operate.
Yeah, one final win I will say there is it's no common knowledge out there that we are in a housing shortage, specifically in the single family, specifically in the affordable housing. If you look at how we bridge that gap the fastest, it's rehabbing distressed inventory and bringing it back on the market. So you are also helping win there as well.
I think that it's a win. We are taking this. There is a magnificent shortage of housing, especially entry-level housing, uniformly across this nation. And so we have these distressed houses that are old, beat up, drug house, distraught tenant, whatever, probate situations. These houses exist in every economic style. They're across the country. And so our borrowers, and we facilitate this, take those junky properties that really aren't habitable and completely rehabilitate them, put in new appliances and put in new cabinets and new countertops and new carpet and lighting fixtures and fix the front yard and get the garage door opener replaced and get this all dialed in. And then that thing's sold to a new home buyer at a reasonable cost. So it really is. I love my job. I don't want to own a car lot. I don't want to own a grocery store. I don't want to be a teacher. I love what I do. I'm helping communities. I'm helping my passive investors invest in our fund and get a good yield of principal protection, and helping these guys improve neighborhoods across the country. And it really is a great thing for our economy to have people like us that facilitate. A lot of people have a negative connotation sometimes with real estate investors. They're greedy, they're this, they're that. No. These people are taking this junky piece of property, they're improving it to the neighborhood, they're getting rid of the toxic aspects of that property, converting it into a great home. We're cleaning things up, and so gosh, pretty neat to be in this business. I'm proud of what we do. Very happy to be what I do.
Yeah, first question I typically get when we'll get into the fund here in a second, but is why don't these flippers and rehabbers out there just go get a bank loan? Why would they go to a source of funds like yours?
Yeah, so that is actually probably the first question my investors in our fund ask. Like, Todd, you're telling me I can earn 8 to 9% passively in your fund after all expenses, plus I get some favorable tax treatments. I mean, and I get a protection of principal with a first position lien. I said that's right. And so a lot of them don't believe that, but it is true. And so why would these borrowers that have a 710 FICO, our average FICO is a 710, our average borrower has experience in real estate, our average borrower is a sophisticated person. Why would a guy with a 710 FICO, a prime borrower that has experience in real estate, borrow money from you at 10 to 12%, and then you pass along 8.5%, 9% to me? That makes no sense. Just go down to the bank and get a loan at a lesser rate. Well, banks in most instances are prohibited from lending on distressed assets. So government loans like Fannie, Freddie, FHA, and conventional banks all get their money from the FDIC. And as a result, FDIC has lending restrictions. So if anybody's ever sold a house that's listening to this program, they've all had the experience of getting that repair order at the end of the day that says, please fix that GFI outlet. And by the way, the self-enclosure pool gate doesn't work. And see that crack in that window over there? We need that fixed. And by the caulking around the fireplace is a section 1 item on the pest. All these things have to be repaired by you in order for FHA, Fannie, Freddie, or even conventional banks to lend on that property. In short, conventional banks or government-backed lending programs are prohibited from lending on severely distressed assets. And so that's number one. And then number two is we're talking about a distressed property with a highly motivated seller. So in that situation, speed and reliability is the number one important factor. This is a short-term bridge loan. It's 9 months or a year, whatever. And so that real estate investor found this property. The property's in terrible shape with a fence around it. The front door is missing, and that seller is highly motivated. So time is of essence. We close our transactions in 7 to 10 days. Speed is more important than the cost of funds. He's only going to have these funds for 10 months. And so those are the two primary reasons why real estate investors with a 710 FICO, with good credit, with good exposure to the industry, that are really good, solid people come and pay us 10 to 12%. Why? They need that money in 7 to 10 days to close on that deal with a motivated seller. And number two, if they went to the bank, it would take 8 weeks and they'd still say no because the fire alarm and smoke alarm batteries are not up to date. And so for those two reasons, banks are not optimal for this. They're not even closely realistic to entering the space. They don't understand this space. They can't enter the space, generally prohibited from being in this space. So it's just not a good avenue. You're either going to have to pay cash for that property as a real estate investor or come to a lender like us, ZINC, or a lender like you in order to borrow those funds from what we call a private money lender. We're not a hard money lender. We're a private money lender. The difference is we are credit-based, background-based, and we look at those attributes just the same. So banks are not a good fit for the space that we're in. And I'm happy about that because I make more money and so do my investors. And ultimately my borrower is just as satisfied.
Yeah, and you've flipped $100 million worth of property, so you know better than I do, really, that the cost of money is just a variable in an equation on whether you're going to do a deal. The second question I typically get is like, why would somebody borrow at 12 when there's cheaper money out there? And it's like, well, if the deal works for them at 12 or 10 or whatever the number is, then they're just going to do the deal. On 7 months, you're talking about shaving a couple $100 off. It's not a huge deal.
At 12%, 11, 10, I can always tell the new investors from the experienced investors because the experienced borrowers don't care. They're like, it's $212.54 extra a month. I'm only going to use the money for 9 months. I just want to know if you can close the thing in a week.
Right.
That's the experienced investor. The novice investor goes, gosh darn, that seems expensive. It's this and that. Well, by the time you spent arguing the rate, that deal's now gone and been sold to somebody else that you were going to make $40,000 on. So you just missed out, you know, comparing us to a bank that's $211 more a month. So the cost of the capital, the interest rate, is a tertiary factor to that real estate investor. They should not care. Anybody that's experienced should not care. What they should care about is, can I work with a private money lender that can close that transaction in 7 to 10 days so I can get that property, fix it and flip it over 9 months, make my $45,000, improve the neighborhood, and get it to a first-time home buyer. That's look, when you go to the fair and you buy that soda for $4, you want that soda then, and you want it right then. And that's why you're going to pay $4 at the fair for the soda. You're not going to leave the fair and go get in your car and go down to Costco and buy the soda there for 59 cents. You're not going to do it. You're at the fair. The soda's $4. You're interested in two things: the speed and reliability of that soda, as opposed to at the fair. This is a dumb analogy. I just made this up, by the way.
No, actually, it's a great
I
analogy.
This up right now, but it is, you're interested in the speed, the reliability at that point. The fact that it's $4, you don't care. And so, you know, you're there to have a good time. You're okay with $4, and it is what it is, because the cost of that soda is a tertiary factor at that point in time. And so the cost of our capital is a tertiary factor. You need it now. You want it in a week and a half. The seller is highly motivated. It's a dumpy property with rats roaming in it. You got to close it quickly. You got to rehab it quickly and get in and get out. And so that's why, you know, but my investors in our fund love it, because they're going to get higher yield coupled with protection of principal, because we have a first position lien on that property. So it works for both parties very, very well.
Yeah. And I'm assuming you guys have a pretty low LTV ratio at the end of the day as well, right?
Yeah. So our lending parameters are really actually relatively strict. Our loan file's, you know, 3.5 inches. I mean, we do 20 to 40 to 50 of these a month. And it's our default rate is less than 3%, and we only take back less than 1% of homes, very, very rarely. So we loan up to, you know, 80, you know, 85% of the as-is value or the purchase price, you know, whichever's less, not to exceed about 65% of the after-repaired value. So we work it from both ends. We work on the back end going, we only want to be in this property at 65% when it's finished. And on the front end, we only want to be in at 85, 90% of the as-is or the purchase price, whichever's less. So we capture risk mitigation on both ends. We got a 710 FICO borrower with 20% down on this property. He bought the property at the lowest price point in that neighborhood over the last 2 years. And then when he's done fixing it up, I'm in it for 65 cents of the dollar. And by the way, when he sells it, FHA is going to come in and finance it at 97.5 cents on the dollar, because the borrower only puts down 3.5%. So the federal government is really the one that takes all the risk. We don't take the risk. We're in at 65. Our average LTV in our fund is around 67, 68%. That's it. And so, you know, that's a very good spot to be. I'm very comfortable with that. These are newly rehabbed homes, and 67% is a very, very favorable term. Even on the front end, we're in at 85 cents on the dollar, call it. And that borrower has to come in with 15% of their own money every single time, no matter what the deal is. So it's very strong on underwriting credit and collateral valuations on both ends of the spectrum. That's how we protect ourselves, and that's probably why we have such a low default rate and a low take back rate. I mean, 1 to 1.5%. Actual foreclosures are a very, very low number, and you know, candidly, most of those that enter that stage are some other calamity in their life, not necessarily the property transaction, job loss, partnership dispute, marriage, divorce, medical, whatever. You know, they walk away, you know, for other reasons, which we all would do. So
same. I want to give you a chance to talk a little bit about your fund and some of the differentiators you've had from other funds I see out there, specifically on the tax. And then I think I read where the fund will take the first $500,000 of loss mitigation. Correct me if I'm wrong there, but talk a little bit about how you've structured the fund to pass along additional goodness to your investors.
Okay, that's a great question. So first of all, I deposit $500,000 in cash. That's cash I put up. I put it with our fund administrator, Verivest, up in Oregon. So Todd Pigott is invested right alongside my investors in the fund. And not only that, but I put $500,000 in cash that the administrator holds onto. I am in a first loss position over any investor in our fund. So if any investor lost any money over the history of their performance in that fund, I would lose my $500,000 first. That's the first thing I do in the debt fund that I run is, you know, hey, If that operator is not invested in the fund and willing to put up his own money, you should seriously consider you have a reservation about investing in that. So number one, not only am I invested with my investors, but I also contribute $500,000 in cash. I'm shocked at how many mutual funds in the stock market where the actual fund administrator is not invested. It's a very, very low number. It's like 5 to 10%. Like you're investing in a fund on the stock market and the actual administrator is not invested with you. I mean, who does that? And so with my fund, I invest with my investors. It's a meaningful cash alignment of interest. And then number two, I post $500,000 up front. So just to say, hey, if something goes astray, I'm the first loss. Number two, our fund has some really good tax benefits. These are relatively new, and a lot of people don't know about them. And they're very hard to get done. So we're registered with the SEC, Securities and Exchange Commission out of Washington, as a Reg D exempted fund for accredited investors. And an accredited investor is a person with $1 million of net worth, or they earn $250,000 a year in income. So this is for accredited investors that have those accreditations. So our fund is built a very special fund. It's built with a REIT inside that fund. And why does that matter? Well, it's very hard to get done. The SEC, we did it. Because we have our REIT within our fund, that enables us to realize some tax benefits. President Trump signed these all into law in 2017. And why he did it? Number one, if you live in a state that has very favorable tax treatment, but your investments are in another state like California, so we're in California, so our income is earned in California. But if you live in Texas or Florida and your income is earned here, it is no longer taxable in the state for which that property, where the income is earned. So for our investors that live in tax favorable states, which is pretty much everywhere outside of California, you're going to be taxed in the state you reside, irrespective of the fact that the income is earned here in California. And so that was never done before. President Trump signed that into law in 2017. Now, President Trump lives in Florida. His earnings are in New York, and that's one of the reasons. But that is why that's there. And so that is there for REITs built within funds. So we have that favorable tax treatment. Number two, investors who put their IRA money in our fund are no longer subject to a UBIT tax, unqualified business income tax, and a tax return. Prior to President Trump signing this, if you invested your IRA in a fund like ours, you had to do a tax return and some unqualified business income tax. And so that's been wiped out. So there's no tax return. There's no UBIT tax. And number three, finally, is really a neat little trick. You are only taxed on 80% of the distributions of the fund on your federal tax return. So we have a 20% tax deduction on all income earnings. Again, these are the three favorable tax treatments that we have been able to get through. They're very hard to get through. It costs us a couple $100,000. But with proper approval by the authorities, the IRS, as well as the Securities and Exchange Commissions, we're able to get those because we have ZINC REIT inside of our ZINC Income Fund. We are able to realize those three tax benefits. And once again, you're only taxed on 80% of your distributions. Number two, if you live in a favorable tax state, you're taxed in the state you reside, like Florida or Texas, even though the income's derived here. And then number three, if you do your retirement IRA account in here, you're no longer subject to UBIT tax. So those are three favorable tax things that we've done within our fund. I will preface this, and not to make this political or anything. That's not the intent of this webinar, but the Democrats are trying very hard over the next couple of years to try to undo those tax incentives. It's come close a couple of times. We hope that does not go away. I think the next sunset is 26 or 27, and they're aggressively trying to remove those. So we'll have to see how that plays out. For right now, we're able to enjoy those tax benefits, and that's something I'm pretty proud of and happy with. And of course, my investors in the fund absolutely love it.
Well, I got to commend you on those three things because we've looked at a REIT before, and the amount of audits and paperwork and red tape you have to go through just to be able to pass along a favorable treatment to your investors from a REIT standpoint is very erroneous. It's high. Now, I want to ask you,
very erroneous, very difficult. You better have a staff attorney. There's only 2 or 3 law firms, as I understand it, in the country that even specialize in this. So, you've got to have a really good law firm. You've got to have a good connection with the SEC and have a good understanding of the tax code to get this blessed. And there's a lot of auditing that's involved in it, a lot of requirements that are involved in it, and a lot of stress tests that you must do. We do all of those, and then we're auditing all that to make sure that we're compliant. But you are absolutely right. It's expensive. I paid that money. I had it done. As a result, my investors are very happy with that. And so it works. But for a Yeah, it is a challenge. You're not just going to fill out a 3-page PDF form and mail it in and get that. It's a lot of work.
Yep. Talk about the 20% taxed, only being taxed on 80% of your distributable earnings, though. I don't think I've heard that before. What is
Yep.
that regulation rule, or how were you able to achieve it?
199A of the tax code is and so a lot of CPAs are not familiar with this. And so if they are a smaller CPA firm or an independent CPA, they won't recognize this. And I get those calls from my investors. My CPA hasn't even heard of this. And so we have to explain it to them and walk it through that. And a larger CPA firms like we have Deloitte, they're very familiar with this and they know right where to go and right what to do. But if you earned $100,000 from our fund, you would only be taxed on 80,000, not 100,000. So that 20%, again, this is your federal tax return. This is not part of your state tax return. So unfortunately, if you live in California, you're still going to have to pay state income taxes. But hypothetically, if you lived in Texas, if you lived in Florida or Nevada, where there is no state income tax, you could, in theory, earn $100,000 from ZINC Income Fund, and you'd only be taxed on the federal side at 80, and then on top of that, you'd pay no state income tax. On top of that, you'd have a first lien security on all the underlying collateral, earn 8 to 9%. It I get I get some people that want to challenge me on this, and I appreciate that. They want to have their attorney look at it or CPA, and I appreciate that. But I've been doing this for a very long time, $1 billion of it, and those are the actual facts of it. We have been able to do this and take advantage of this as we should. We worked hard for our money. And we want to invest it in a safe place and be able to reap those rewards. And so I'm thankful for the president signing these things into law in 2017, because it's pretty neat to be able to not have pay tax on 20% of your earnings. And so that's how it works. If you make 100 grand, you're only going to be taxed on that $80,000.
Yeah, the only thing I challenge you on is you missed one state out of there that's the best no income tax state, and that's the state of Tennessee.
Is that where you are?
That's where I am, Nashville, Tennessee.
Oh man, I've heard good things about Tennessee. I've heard very good things. I've got several friends that are moving to Tennessee. You guys are taking some of the disgruntled Californians over there. I think that's starting to happen.
Yeah, they all live right across the street from me. I know.
That's awesome.
I don't want to breeze over the fact that you all are in 40 states. We were chatting a little bit before the show. We have a debt fund as well. We operate primarily in 2 states. We've expanded to 4, but it's very slow going. How were you able to expand to 40 states? That's incredible.
Yeah, so cost us about 75 to 100 grand in legal. We did a mortgage survey across all 50 states. We did a mortgage survey, and then we evaluate all the laws, evaluate all the licensing requirements, and be able to enter those states where we want to enter. So ZINC is, not to go too deep into this subject, but the country is 50 states, right? About a third of them are non-judicial states, about 2/3 of them are judicial. And so what that means is in the judicial states, you have what's called a mortgage. That means your deed on that property actually transferred to the recipient. It actually transferred, it left your hands. And so in the mortgage states, you have to actually foreclose through the judicial process, go to court, get a lawsuit, et cetera, et cetera. And so it takes a little bit longer. It's a little bit more risky. And then some of these states can be very risky, like New York's enacted laws that makes it even more difficult. So some of these foreclosures and laws are dragging in years in a place like New York. That's why we don't lend in New York, is because it's a judicial state, mortgage state. On top of that, they've enacted these laws to protect people, which is wonderful. But if I need to go in there and get my collateral, it's going to take me 7 years. A third of the country is non-judicial. What that means is called a deed of trust. A deed of trust state is a state where that deed of that property is never actually. People don't understand this. You do not own your home. That deed of trust is in trust at the trustee. It's held there until you actually give me all my money. And so in those states, it makes it very easy to repossess that collateral. It takes about 90 days. And so what we do is in the non-judicial states, if you don't pay Mr. Todd first thing in the morning, Mr. Todd comes in and takes that house very quickly, typically in about 90 days. In the judicial states, we're very cautious. We require a little bit more down. We're a little bit more stringent on that underwriting because we know that we have to judicially go to court and get that judgment. But in either scenario, we're in 40 states. What do we look for? Here's what we look for. We look for velocity of those homes, absorption rates. Are those homes in a desirable community of 30,000 plus, where the population is commerce? Commerce is existing in fluid form. The absorption of real estate is moving at a fast pace. The economy is doing well. So in those states where we enter, we only go to communities. I call it my curbs and gutters theory. We only go to communities, curbs and gutters, meaning a 3-bedroom, 2-bath house with a curb and a gutter. McDonald's nearby, a Starbucks nearby, there's a church and a school, and it's in a community that's well established with a Starbucks and a McDonald's. If there's a Starbucks and a McDonald's, there's commerce going on there because they already did the work for you. McDonald's already spent $500,000 to go, this is a good spot for McDonald's. So a lot of people drive by here every day. And so they've already done the work for you. So just follow McDonald's and follow Starbucks and follow my curbs and gutters theory. If there's a curb, if there's a gutter, if there's asphalt, there's McDonald's and Starbucks nearby, or PetSmart, whatever you want to call it, then there's commerce there, there's people there. That's a good location to be. Those national tenants have already done the work for you. There's enough traffic there, there's enough people there for the absorption rate of that collateral to move quickly. So I look at the absorption rate. If that collateral is moving quickly and there's a lot of commerce there, then that's where I want to be. Providing that the laws are favorable, that I can get to my collateral in the event of a default. So I hope that helps your listeners a little bit on where we go and where we try to select.
Yeah, you said McDonald's and Starbucks, but what about Dutch Bros? Do we follow the Dutch Bros yet?
No, Dutch Bros is off. I'm just totally kidding.
Yeah.
My daughter goes to the University of Arkansas. She's studying accounting there, and she freaking loves that Dutch Bros. And so every time she comes home and visits me, I take my daughter Cameron. We go to Dutch Bros, and it's freaking a long line, overpriced. I'm like, whatever. I got to spend time with her in the car. But anyway. That's
1,500 calories and 200 grams of sugar to start your morning.
God darn, she's got this special drink that takes like 8 words to spit out of her mouth. And then it's $4.50 for what? So anyway, but no, just kidding. Yeah. We have a great time. My daughter loves that place. She's 19, she's in college, and every 19-year-old loves Dutch Brothers. So anyway, we do go to those. We do go there.
So you've got a big impact with $1 billion of originations, 40 different states. I'm interested in your viewpoint on a couple things going on in the real estate market today. The first obvious question is rates. How are you seeing rates impact your direct lending business today versus 3 years ago?
Hey, fellow investors. Before we dive into our next segment of the show, I wanted to take a quick moment to talk to you about a fantastic opportunity for you to invest with me. As you know, here at Ice Cream with Investors, I'm passionate about real estate investing and helping you navigate the exciting world of wealth creation through real estate. And that's why, for the first time, I'm thrilled to tell you about an opportunity for you to invest alongside of me. Over the past 3 years, I've been investing in multifamily, mobile home parks, car washes. I've even become the bank and lent out money to fellow real estate investors on a short-term basis. And now you can come join me. If you would like to jump on a call and learn more about this opportunity, head to icecreamwithinvestors.com/invest and find a time for us to connect. And now back to the show.
Okay. So rates. Rates are going to stay elevated. They're not going to be coming down considerably anytime soon. We may never see the rates of those 2s and 3s again. Right now, they're not necessarily affecting us, and here's why. I met with, and I had lunch with the chief economist of Moody's. That's right. So here's what's happening out there. Pricing of used homes is so elevated because of the shortage of supply that they're staying very elevated. New homes, believe it or not, are being built at a reasonably fast pace here. So what's happening here is these new homes are being built. And how are those builders moving those homes? They're buying down the rate. And so my son is buying a new home right now. He's buying a new home right now, and I'm helping him. And he's a police officer, and he's buying his first new home. He's only 22 years old. And so, he was able to get a 5.1 rate, 5%. In essence, the builder contributed $17,000 to closing costs and to buy down that rate. And so 5.1 is a reasonable number. He can buy that house, he can make that payment. That's a reasonable number. So rates are not affecting new housing as some would expect because the builders are participating in that rate buy down and simply adding it into the price. And so that's working very good. Used homes, we are not seeing price depreciation because of this rate. As a matter of fact, what we have here is kind of a shadow effect. We're having a bigger problem, and I'll talk about this if I could. Number one, people are not moving from their homes because 2/3 of them have a 3.5 or under rate. So they're not moving. Instead of going from a 3-bedroom, 2-bath to a 4-bedroom, 2-bath, they're not. They're just staying put and putting in bunk beds. That's all they can do. They're not willing to. So we have a lockdown effect, or shadow effect, a lockdown effect on existing homes. Listen to this. I pay $6,000 for this report, and this is really important. It's from the General Services Administration. This is the mortgage servicing report. It's 160 pages of spreadsheet in Excel. This is why this is important. The GSA tracks all mortgage centers across the nation who do government-backed loans, which is about 90%. So the government tracks all these metrics at these loan servicing centers, everything and anything. I buy the report, I pay the $6,500, and I extrapolate out the data that I want. And that data that I want is what I call stress points. The stress points that I look for at the mortgage servicing centers are this. What are the calls that come in? I can't make my payment. Is there a skip a payment? Foreclosure avoidance, forbearance avoidance. I need a loan recast. I need a loan reamortization. I need to skip a payment. I'm unemployed, la, 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 la. All of these calls that come in are mapped. They're checked and they're quantified. I put in a big giant spreadsheet, and the government uses this to measure statistics. I buy it and I spend this money, and then I pull out the data. I pull out the data I'm interested in. And so the data, listen to this, the mortgage surveying across the country right now, the mortgage performance rates are the highest in 55 years. Why? Record low rates, record high equity. We are not in a bubble, ladies and gentlemen. Todd, are we in the next bubble? No, we're not. I speak at conferences. The last conference I spoke at had 450 people. I put these graphs up on my PowerPoint. We have the largest performance of mortgage history across the country ever in 55 years. Number one, they have record equity. Number two, they have a record low rate of 3%. Finally, all of these loans that have been done in the last 15 years are full doc, fully amortized, 30-year loans with people that have the income. They are not the loans of the last bubble, which was caused by stated income, stated asset, negative amortization, and by the way, if you breathe, it will give you the loan. That's what happened before. We don't have that today. These are full doc loans. So with the mortgage performance so high, we don't have defaults coming at a high level. We do not have that coming. Now you might see on CNN, mortgage foreclosures are up 25%. No. It's at 0.04% last month. So it went to 0.06. It is so low and so tiny. Yes, it moved 25%, but it moved 25% on a minuscule number. So they're not giving you the full story. We have mortgage performance very high. So housing today, interest rates today are not having the effect that people might hear from the news channels. I know this because I buy the data, extrapolate the data. Housing is very, very strong right now. Mortgage performance is very, very strong across the country. We don't have foreclosures coming. We don't have a big default coming. We don't have a wave of anything coming. They have record equity, record low rates, and finally they were all qualified for that loan in the first place. So we don't have those coming. And then on the top of that, we have new home construction, operating at a pretty fluid pace because they're getting rates at 5%. And then we have these people that are locked down in their homes that aren't moving because they don't want to lose that rate. So what's that leave? A massive short supply with more people wanting to buy, and it's not there. And so here's what we're going to have. We're going to have a reset in our brain. 5 and 6% is no longer going to be a high number. We're going to understand that that's a low number. My first house, I'll never forget. My first house, I had quoted 10. I have perfect credit, 10.25%, and I paid money to get it down to 9.85, I think, just so I could say I got it under 10. That was my first house. My dad's first house was 17% in Anaheim, California. So that's just what it was. 5%, 6% is not bad. That is still a very doable number for the wage earning power of Americans. They're just going to have to reset their brain that money's no longer free, and it's not free. Yep. That day is over. That was an unrealistic pace. I said this will end in either inflation or denominatization of our currency. There's no way you can have a 25 basis point cost of money at the Fed window. There's no way. You're going to have rapid inflation. I said this 3 years ago, 4 years ago, 2 years ago. You're going to have rapid inflation or denominatization of our currency where currency starts to lose value. They're going to have to increase the rates. They've done that. It's a reset in our brain. They're still fine, folks. They're 5 and 6% on used homes with constricted inventory, and on new homes. You can afford it. We're back to normalization. The rates are not high like you think they are. You're just used to free money. So
go look at 1970, 1980s data. We are certainly not high. Even I think in the early 90s, mid 90s, we were around the 6.5% rate. The only kind of pushback I think on the rate discussion, which I tend to agree with you that rates will not come down fast or meaningful for a very long time. We are higher for longer. Is this idea of what do we do in commercial real estate, and then what do we do at the national level and the debt and the interest payment that it's causing now that we're having to sell the bonds at a higher rate? Any commentary around
I don't
that?
have any comment on the bonds. The commercial sector, I think, boy, that's a difficult one. That's
Yeah.
it. Now, I'm not. I will. That is a difficult one with the work at home and with office space being where it's at, and all of those loans coming to reset. See, people don't understand. And a lot of your viewers might not know this. In the residential sector, we offer 30-year loans. The federal government backs those loans. Those were rolled out in the 50s and 60s to spur home ownership after the war ended. Before that, we had 10 and 15-year amortized loans for housing, believe it or not. That's why homes were so small back in the 20s and 30s, like they were 800 feet and 900 feet, because you had to pay cash or get a 5 and 10-year loan. That's how that worked. And so when the war ended, World War II ended, the federal government launched this loan program for a 30-year loan. And they did that at that time to spur commerce. And that's why you see homes in the 50s and 60s go to 15, 1,800 square feet. You know, those 15, 1,800 you didn't see back in the 20s and 10s because nobody could afford to pay for that in 5 years. So they rolled out this 30-year loan, and that's why you say homes become 15, 16, 1,700 square feet in the 50s and 60s. So we have this 30-year product that exists in housing, but we don't really have it in commercial. Most commercial instruments are 5-year, 7.5, 2-year, or floating for 5 in the reset. That's how it works. And so now what we have is a wider problem. We have all these commercial loans out there that were written for 5, 7, 10, whatever you want to call it, three ones. Those are all coming to be reset, and I think we're going to have a problem there. I personally do not want to be in commercial real estate or retail. Both of those segments are, in my opinion, deeply troubled. Everybody's going to online or delivery, et cetera, et cetera. So that retail is very problematic. Those large box retailers, I don't know what you're going to do, because the online is just gaining more traction and delivery is gaining more traction. You can now do a warehouse in the middle of the Mojave Desert and ship those TVs. You don't need a big Best Buy anymore. You just don't need
Yeah.
it. And so retail is going to have to be what I would consider repositioned, and I think commercial is going to have to be repositioned as well. And so I think we have an element of turning that into low-income housing or some other purpose other than what the purpose is it was built for, because those commercials are going to come due. Commercial loans are going to come due, and not those guys are not going to be able to refi. That thing is not going to be able to cash flow at a 5 and 6% like it did at 2.5. And so some of these are going to be in trouble. Sorry to elaborate on that, but yeah.
No, I think it's interesting. I mean, I think some of the big box retailers are using themselves as small distribution centers now. So instead of building multiple distribution centers outside of LA, why don't we just pop a couple Best Buys in there, and we've got now an omni channel that we can distribute out of. So I think that's the trend there. And then for the malls or office spaces or things like that are in more remote locations, as long as you can get them power, I'm interested to see if those don't get converted to data centers. Like this whole AI boom that's going on right now. I don't know if you're following much of it, but we're running out of data center space and we're running out of power to go power these things. And I think that's how some of that stuff can get repurposed.
I agree. I think some of these malls are just going to have to be repurposed. Some of this commercial is going to have to be repurposed. I don't really know what that looks like. I'm a big believer in the residential space, which is where I kind of stay in my lane. But I am familiar with it. It is an offshoot. And I do know this, I would not want to invest in a mall or a shopping center today, especially with tenant mix that's going to have to rely on that big retail consumer. We're moving at such a fast pace with online and AI. Oh my gosh, that's going to completely change the shopping experience. I mean, pretty soon you'll be able to try on clothes in your own room on your TV. AI is going to figure out how to do that. So we have this artificial intelligence. I don't know. Retail and office is, I think, a very problematic space to be in.
Yeah, which is why I think we were talking a little bit offline here. Is if you're a retail investor, you're looking to have some exposure to real estate. You want to get some cash flow going into your pocket, into your bank accounts. Probably repositioning malls and doing some of this fancy stuff that you see the pros try to tackle is not the best place for you. Like a good, consistent debt product that puts cash in your bank account every single month is probably a better place to start.
I am very passionate about this. I have numerous friends that have been burned on these funds that go out and buy assets. They're equity funds. They go out and buy assets, shopping malls, and commercial, and it's a whole period of 7 years, and they put together this fancy, colorful pitch deck, and they're going to reposition this thing, and they're going to make XXX IRR, and it all looks wonderful. You have to get, I can also drive from Fresno to Los Angeles in 3.5 hours if I hit all green lights. But the probability of hitting all green lights on a 4-hour drive from Central California to LA is not very realistic. So I don't think you can hit all green lights in 7 years on an equity investment. It just doesn't happen. Everything can go wrong and not a lot can go right. So buying that mall and buying that retail center and trying to reposition that, you don't get your money. You're not getting your monthly payments. You have to have a lot of things go right. I have a debt fund. You have a debt fund. It's real simple. We loan on a house. It's like a McDonald's hamburger. It's so simple, everybody understands it. We loan on a house. The guy is going to pay us because he's have a 710 FICO, and he's going to make money. He's profiting already. And he's going to move that property in 7 months. So he's going to pay us our money. And what if the world collapses, Todd? Well, that could happen. And then I'm in my pickup truck and we have rentals. So I have rentals, single family residential rentals. If the world collapses or something very bad happens on U.S. soil, an assassination or another chemical attack, something of that nature. If something really bad happens and the market really shifts, I've got rentals. Cash flow. If nothing bad happens, I've got cash flow from this guy who's going to buy this home, fix it up, and sell it to an FHA home buyer with 3.5% down. It doesn't get any less risky than that. We get our money every single month. It's passive investing in real estate. You don't have to do the work because the owner's doing the work. So we're not going to deal with the property manager or the plugged toilet. We just simply collect our cash every single month. It goes into a trust account, Verivest up in Oregon. We're monitored by the state. We're monitored by the federals. And every single investor in our fund gets an ACH deposit on the first day of the month by 12:01 a.m. And it's done. And I can't think of anything safer or more lucrative than that. A lot of my friends have gotten burned on the equity funds. I just don't think buying an equity fund and repositioning properties, especially retail and commercial, is where I want to be today. I think it's very, very risky, but I'll tell you what, entry-level housing, very needed, very cash flow orientated, works very well, and that's the space I'm in, and it's done well for us, and I think it does well for you. So debt funds are where it's at. Absolutely. Equity funds I don't really want to participate in because there's too many things that have to go right in today's climate for me to get my money in 7 years on the hopes that I'm going to get interest in asset appreciation.
Yep. Well, Todd, I could talk to you all day. I want to be cognizant of your time, though, and switch us to our last round. We call this the 4 toppings. Our first one is, what is your favorite book, or just what is a book you've read recently that's given you a paradigm shift?
My only favorite, but I'm a big reader of periodicals, news magazines and newspapers like the Wall Street Journal. I don't read a lot of books, but my favorite one is probably Rich Dad, Poor Dad. I mean, I just can't think of a more freaking awesome book than that. So Rich Dad, Poor Dad is a great book, and I wish I had read it at 18 and followed it at 18. I'd be a whole lot farther along than where I'm at today. So it's an excellent book to read. Every high school graduation gift should include a Rich Dad, Poor Dad book.
That's what I gave my nephew for his high school graduation, actually.
There we go.
Our second one is, what is the best piece of advice you've ever received?
So it's the advice that I use today. So you know what? There's a lot of things that are going to go wrong in your life. A lot of things. A lot of decisions. A lot of things you wish. A lot of things are going to go wrong. If you don't drink a lot of alcohol, if you don't smoke, and if you eat right and go to bed, set your alarm early, get up and exercise and go at it every single day and do the honest and right thing, everything else will come out easy. And I really do believe in that. I operate with complete transparency here at ZINC. If I make a mistake, I own up to it. I set my alarm at 5:45 and 6 in the morning. I ride my Peloton every day for 15 minutes in the morning. And I ride my mountain bike and road bike in the afternoon. So I exercise. I don't smoke. I don't do drugs. I eat a keto diet. I work hard every single day. And I'm just very transparent with everybody. And that's the advice that was given to me. That's the advice I follow. And that's how I work. So I tell my kids every day. I got 3 kids. You know what, man? I tell them, and they're doing it. Like, guys, if you're just super honest and transparent and truthful, and you freaking go to bed and sleep right, and get up and exercise, and eat right, you're ahead of 90% of the pack already.
We're going to have nerd out on cycling afterwards, as you can probably tell in the background. I'm a huge cyclist as well.
Awesome.
Our third one is, what are you most proud of in your life?
I was on welfare at a very young age. We lived very, very poor. We lived on a lot of pot pies and TV dinners. And gosh darn, this is a long story. And it was very, very rough. Very, very rough. I played water polo and swimming in high school. I got about 3.85. Rolled in Fresno State. Withdrew from Fresno State. I could not afford the tuition and books. I was working at Big Five Sporting Goods. I made $2.61 an hour after taxes. Broke, eating pot pies. My mom was broke. We freaking had nothing. It was so bad. The church brought us our Christmas presents. Anyway, I sat in the parking lot in 80 something. I had $17 to my name, and I said, "What am I going to do?" I freaking sat out there for 5.5 hours. Long story short, I went home and water polo at that time was ending at 5-7 or 5-7 or 9 at night. Harold Zane was our coach, Fresno State University, and he changed the time every night. I don't know why, but he did. So I needed something I could do on my own time. Like, how am I going to make money? I'm freaking broke. I'm eating pot pies with my mom. I can't afford tuition. My mom's at home crying. We can't pay our utility bill. The freaking lawnmower doesn't even work, and all this stuff's going wrong. And it was really, really tough. And so it was so tough. And no air conditioning because we could afford that. So anyway, so that was the start. So I took the $17 I had. I went home and go, "Mom, I got water polo ends at 579. I got to borrow your vacuum. I got to borrow a trash bag." So we're knocking on doors. And so I knocked on doors, and door one was Double B Produce at $63. And I got Pat Rogers Association $60. Warren Love Construction, I got him for $60. And my third tenant was Spano Enterprises at 210. By my third month in business, I was up to $800. So I built that company over 17 years to 550 employees, 50 contractors spanning 3 states. We did Target, Mervyn's, Albertsons, PetSmart, Smart and Final, you name it, we did it. I did facilities maintenance, interior janitorial, exterior janitorial, pressure lot, parking lot sweeping, malls. I did a lot of malls, all those things. Anyways, I sold that company in '06, rolled into ZINC. So I think the most thing I'm proud of is back when I had that $17, I turned it into, a multi-million-dollar company, and then eventually sold that, and then rolled it into ZINC. Very tough period. A lot of people don't. Gosh darn, don't even get me started. I worked every Saturday and Sunday for literally a decade. I worked every Saturday and Sunday. When I say every Saturday and Sunday, every Saturday and Sunday. It was terrible. Terrible, terrible, terrible. It was freaking so bad. But I did it, and nobody wants to work Fridays. Now nobody wants to work Mondays. By the way, you're going to have to cut and edit this tape because I know some of this you're not going to want to get out there. But now nobody wants to work Mondays. Nobody wants to work Fridays. I need 2-hour lunch. I got to take my dog to the dog sitter Thursday afternoon. And by the way, Tuesday morning I can't come in either because I have yoga. And so, by the way, can you work with all that? And that's today's climate. But back then, I had to kill myself, and I did it, and I built that company, and that's the thing I probably am most proud of.
Todd, don't bury the lead. Next time, start with that. That's a humbling and amazing story you got there.
Well, thank you.
Our fourth and final one is, if you could sit down and eat a bowl of ice cream with anyone, dead or alive, who would it be and why?
So I can't say I don't know the person. I don't know the person, but I will leave you with this. The people that I really want to meet is not a specific person, but the people that I really want to meet and I most admire are the people that contribute probably to medicine or inventions. So I would want to meet the guy that discovered a cure for a specific cancer. I would want to meet the guy that created something that helped the humans. I am not enamored at all with famous people, football players. I have no offense. My son's really big into the football. I go to the NFL games. That does not impress me. It does not impress me. I know a couple of these. I got a dinner last Thursday with Kurt. He was a pitcher for the Milwaukee Brewers in the major league. And a good friend of mine, Terrence Frazier, he was a pitcher for the Oakland A's. So I got a couple famous people. They don't impress me. No offense, guys, but I'm not impressed with wanting to go meet an NFL player or a singer or even a TV show person or an actor. No offense to any of those people. There's nothing wrong with it. I just don't get. If I saw them walking on the street, it would do nothing for me. But if I had only a week to live, and they said, "Who do you want to go have a bowl of ice cream with?" I'd say, "Who fixed polio, or who fixed cancer, or who fixed, who did the heart transplant with the pit?" I'd like to go meet those people and have a bowl of ice cream with those people. That's the person who's moving and shaking. Anyway, I don't need the NFL player. I need the guy that did the heart transplant. I think that's pretty cool.
Yeah, I love it too, because you spend your entire life on this problem that you think you can solve, not knowing if you can solve it or not. And even if you do solve it, chances are you're not going to get noticed and recognized. So you just spent your entire life trying to solve a problem better for humanity.
Correct. Yep.
What a great answer for that. Well, Todd, fantastic having you on the show. Ton of value here. If our listeners wanted to reach out to you, learn more about ZINC, or invest with you, where is the best place we could point them?
So thank you very much. I really thank you for having me on your program today. I hope I provided some value to some of your listeners out there. I am Todd Pigott. I am the president of ZINC Financial, managing member of the ZINC Income Fund. And for anybody there, if anybody out there is a borrower that is a fix and flipper and you need a loan, that website is zincfinancial.com, zincfinancial.com. And our phone number there is 559-326-2509. If you're a high net worth investor and you're looking for passive investing in real estate with a debt fund that earns 8 to 9% passively with excellent protection of principal, no losses with an operator that's done $1 billion of this and excellent tax benefits, you can go to zincinvesting.com. That's ZINC for my 3 kids, Zachary, Nicholas, and Cameron. Just throw that in there. I had to make a word, so I needed a vowel, and zonk didn't work, and zank didn't work, so I made it ZINC. So that's our name. Anyway, okay, zincinvesting.com is our debt fund, zincinvesting.com. And there's information about our debt fund. We operate in 40 states. So if you're an investor wanting to passively invest, but yet you want the principal protection of real estate and you want some tax benefits, visit that site or give us a call here at the office, 559-326-2509. Make it a great day.
Perfect. Thanks, Todd.
Thank you for listening to Ice Cream with Investors. If you like what we serve you here, it would mean the world to me if you would like, subscribe, and leave a review on your favorite podcast app.